And that's what I did.
The last time silver had reached a parabolic top, well, after a top after a parabolic move, rather, 2011 and 1980. Those are the only two times in history it's done that. Both times it's lost at least 70% of its value.
What's going on, everyone? Welcome back to the channel. So in this video, we're breaking down a really bold call from Clem Chambers, and this one's getting a lot of attention in the precious metals community right now. He's pulling up historical data from 1980 and 2011 to make the case that silver could lose 70% of its value from the recent peak. And he's explaining why he got out before the crash while so many retail investors got caught holding the bag. But here's where it gets even more interesting. He's already moved on to the next commodity play, and he thinks copper is about to do what silver just did. There's a lot to unpack here, so definitely stick around because the ending gets into the actual mechanics behind why all these metals dumped at the same time, and it's not what most people think. Real quick, drop a comment and let me know where you're watching from. I love seeing where everyone's tuning in from around the world. All right, let's jump into this.
I've been saying that Bitcoin's going to go into a Bitcoin winter for I can't tell you how long, but nonetheless, here we are. It's finally done it, or finally doing it.
Well,
And I was saying last week after Friday over the weekend that it would bounce now, and it's bounced, and now it's all over the place. So we're in. I mean, gold is the driver, but silver was the fast horse, and it ran away and went mental, and it pulled back and put everything down with it. And now we're back into a sort of stabilization phase. But boy, is it volatile. Really, really volatile out there.
Well, I haven't spoken to you since a couple of weeks ago, and a lot has changed. Gold is down. Let's just take the top to trough. It has gone down 20%, including the rebound recently, 13%. Same thing with silver. It's already down. Well, it was down 40% peak to trough. And I guess counting the rebound the last 2 days, down 30%.
Avalanche.
My question is, Clem, would you be buying at current levels, especially given the last rebound from the trough in the last one day, 24 hours?
Okay. I hold a lot of gold, a lot of platinum, and way more than that palladium. Mm-hmm. So I hold them, which is the same as saying, would I buy them? If I didn't have them, I'd be buying them. Silver, no, I wouldn't be, because silver ran away. So if you put silver and gold over each other on that chart there, you'll see that silver just took off and left everything else behind.
Yeah.
Now, as far as I'm concerned, I'm expecting gold to pick up on the trend that it was on before it went almost vertical alongside silver, and it will just grind along like that. And silver will reconnect with gold, and they will be tracking together, and it won't be making the running. And then silver becomes interesting if you think gold is going to keep on going up, which it probably will. But I don't need to get onto silver now, because silver was going to be the fast horse. It was going to be the retail juggernaut, as I believe I said on several of your shows. And it did that, and it bubbled, and it busted. And now it's going to go back to tracking gold. And the only reason why it will run off crazily again is if it becomes the fast horse, i.e. retail FOMO kicks in, and that will only happen if gold continues to grind up and say go through 6,000, and everybody
Right.
retail says I need silver again. So that was the only reason I'd ever think about getting back into silver.
If you just look at the chart, Clem, silver follows gold, or has been following gold. So if you're somewhat bullish on gold, wouldn't you also
put a few years
be
on that? Give it 5 years and have a look.
Yeah, okay.
Yeah.
So yeah, so the blue line is gold, and the candle chart is silver.
Yeah. Now, if you actually, if they were scaled on the same percentage scale rather
Sure,
than
let's do that.
numbers,
Yeah, let's do that.
yeah, you should see. Look at that. Silver just ran away.
Yeah.
Yeah. And that gap, when that gap's closed and they're kind of tracking again, that's when silver would have repriced properly. And then maybe, is that how many years? Yeah.
That's
is that
5 years.
years? No,
Yeah.
yeah. Okay. And then maybe that will be the right price, because it ran ahead and you can see it's pulling back towards gold again. And I expect gold to grind up, and I expect silver to grind down until they kind of come back roughly together again, and then they'll track. And then that would be the right price for silver. Then maybe I might think about getting in, but really I wouldn't, because it's all about gold and platinum and palladium, which has got a lot of upside.
Right.
But if silver suddenly took off and did a fast horse, I might take a short-term position in it. But I'm not a short-term positioning guy. I mean, I said on Friday night to all my guys on X and on YouTube, on my channel there, I said, I really feel like I should trade this tonight because it's going to bounce at the end. But I can't be bothered. I'm going to go out and drink 4 martinis.
Okay, so Clem Chambers absolutely nailed this call, and I need to break down why this matters for anyone still holding silver right now. When he said, I told you I was out of silver and that it was going to go belly up, he wasn't just making a prediction, he was reading the technical setup that so many retail investors completely missed. And here's what's critical. Silver hit that parabolic peak at around $34 in late January 2025, then crashed over 30% in just days. That's not normal consolidation. That's a retail euphoria collapse. Now, when Clem talks about silver being the fast horse that ran away and went mental, he's describing something we've seen historically in commodities. Silver outpaces gold during euphoric runs because it has lower liquidity and higher volatility. The gold to silver ratio compressed from 90 to 1 down to around 75 to 1 at the peak, which historically signals silver is overextended. And look at the 5-year chart comparison he's showing. Silver's percentage gains completely detached from gold's steady grind. That divergence is your warning sign. When he says, I expect gold to grind up and I expect silver to grind down until they kind of come back roughly together again, he's talking about mean reversion. Silver needs to reprice back to its historical relationship with gold before it becomes a buy again. And for anyone thinking about jumping back in, understand this. The repricing phase can take months. Don't chase falling knives.
And that's what I did.
The last time silver had reached a parabolic top, after a parabolic move, rather, 2011 and 1980. Those are the only 2 times in history it's done that. Both times it's lost at least 70% of its value. So it hasn't done that yet.
Go back to that chart. Go back to the early one. Yeah, you see there's a break in the middle there of the parabolic. Go down, go down, go down, go down, go down.
Which year are we looking at?
There. You had it. You had it in the middle of that parabolic. There's a break.
Okay.
Up a bit, up. There. Stop. That's a break there.
Yeah.
Now, a lot of people would say that's where silver is, and I would say it's up at the top there.
Here, yeah.
They would say it's there. And I would say it's at the top one, and we've had that fall, and now it's going to potentially trade sideways. Yeah. So I would say it's actually at the top, and it's pulled back in that big dump. And now we're going to go sideways and maybe have a double recovery, and then who knows after that? Because that silver is not really driven by a gold explosion. Maybe it was. I can't remember, frankly. But if gold continues to grind up, it will go quite a long way. It will go to maybe 8,000. And if gold is not going to grind up, and we've had the precious metal run, then we'll get a big fat. What you see in silver back in 2011, you'll get that sort of form. That's what will happen to gold and silver. Yeah.
I mean,
I've got a suspicion it won't do that. So 2011, that big silver move there.
Yeah.
Yeah. And all the way up and all the way back down again. That's what you're going to get in gold and silver if gold is not going to go up anymore. Yeah. If we've had it, that's it. We've had our fun. It's now going to pull back the whole complex. Then it will form a sort of pattern that you see between 2010 and 2013.
Does it make sense to you that copper is also exhibiting similar patterns right now?
Yeah. So copper's going to do what silver just did, but it's not done it yet. It's just starting. Yeah. So my focus actually has kind of moved away. Well, but I'm not in silver anymore. It's shifting through the precious metals into copper. And in at some point in the
Yeah.
future, probably after copper explodes, my shift of focus will be into oil.
It just looks
Yeah,
like the
so it's
entire metals complex, palladium, platinum, copper, metal, gold, and silver, they're all doing the exact same thing right now.
yeah, yeah.
Some institutions or some entities are trading these pretty much in tandem with each other. I guess
They're
as a
all tied
block.
together.
I'm not really sure. Why
Let me
is this
tell you how
happening?
it works.
Yeah.
Let me tell you how it works. They're all tied together. Everything's tied together. Even the price of peanut butter in Mongolia is tied up with all the markets. Everything's all tied together
Yes.
via currencies and forex and arb and all sorts of stuff, right? That's how
Yes.
markets work. So when a whole complex, the precious metals in this case, goes up like a rocket, it's almost well, it is guaranteed to
I
come
mean,
down like a
look at
rock.
this chart. Just in the last 2 weeks,
Yeah,
the
yeah,
price pattern has been exactly the same.
yeah. Yeah. Now the reason for that is there was a funny enough, there's two theories behind what happened, and the big one that everybody wants to believe is that there's some evil conspiracy of huge whales that push the market around, and it's all a big fix.
This is the moment that should make every silver holder stop and pay attention. When Clem said, "The last time silver reached a parabolic top, 2011 and 1980, those are the only two times in history it's done that. Both times it's lost at least 70% of its value." He just dropped the historical precedent that nobody wants to hear. Let me give you the numbers. In 1980, silver peaked at $49 and crashed to $8 by 1982. That's an 84% collapse. In 2011, silver hit $48 and fell to $14 by 2015, a 71% drop. We're seeing the same parabolic structure form in early 2025. Now, does this mean silver will definitely lose 70%? Not necessarily, but the pattern is undeniable, and here's where it gets interesting. Clem's now shifting focus to copper. When he says, copper's going to do what silver just did, but it's not done it yet, it's just starting, he's identifying the next hockey stick move in the commodity cycle. Copper broke above $4.50 per pound recently, and if you look at the supply deficit projections for 2025 and 2026, driven by electrification and grid build-out, copper has legitimate fundamental support that silver's retail FOMO didn't have. And his gold prediction? He said, if gold continues to grind up, it will go quite a long way. It will go to maybe $8,000. That's not random. That's based on central bank buying continuing at record pace. 1,037 tons purchased in 2024 alone. The difference between gold and silver right now? Gold has institutional support. Silver had retail hysteria.
Okay. My point of view is at the end of a month, there's a lot of funds that have too much of a asset that's gone up too much and maybe shouldn't even have it because it's not in their mandate.
Yeah.
Yeah, and they see it's going to go up, so they jump on board because after all, they're let's just say highly speculative. Maybe they're not meant or allowed to have much of it or any at all. But come the end of the month, they better sell. So when the compliance team comes in and looks at it, they're not going to say, "What's this gold doing here? We're not meant to be in gold. We're meant to be a shipping ETF or whatever or fund." Or a low risk fund, or you're not allowed to have more than 1% of the fund in gold, and you've got 3% because it's gone up so much. So they sell at the end of the month. And then all these funds, because it's gone up so much, head for the exit at the same time and blow everything up because they can't get out of it's panic on the dance floor. And then after the month starts again, they all get in again. So last 2 days of the month, it all goes pear-shaped. And the next 2 or 3 days of the month, it all goes up again. But it's all about positioning, and it's all technical. Now, you imagine the market has run so far, and certain funds, etc., have made so much money, and they absolutely do not want to get out because it's going to run and run and run. But they have to, because they've only got a day and a half to get out. Otherwise, they're in trouble, or they're going to have some explaining to do. window dressing is what it's called. It's what the Santa
Yeah.
rally is all about. It's why markets go, strange at the end of every quarter. And this is an exacerbated one of them, because the profits and the move involved in those assets is so large that when they all try to leave, they cause a cascading avalanche.
Right.
And that's what I put it down to over the weekend. And I said Monday and Tuesday it will be up, and lo and behold, Monday and Tuesday it's up. Now, of course, the other theory that it's Mr. Evil under his volcano, they say, well, I mean, now they've shaken all the weak hands out, they're buying back in, and all that stuff. So take your pick. Boring or exciting.
I can just imagine Mike Myers' character somewhere in a volcano dumping all his silver.
$1 trillion.
That's exactly what's happening. Not if you just, Clem, if you look at what happened in the past, okay, silver and gold together. I'm just looking at gold for now. Here's my rationale. Just hear me out and maybe disagree with me if you don't like it. So in the past two shakeouts, 2011 2012 following 2011, and then 1981, gold's down something like 62% from the top, and then 50% from the top. And look, it's been a pretty consistent pattern in gold's history since it started free floating in 1971. And so I'm looking at this, I'm saying I don't want to buy gold until it's dropped at least 50% from its top, which it's done consistently in the last two times it's done this. So I'm going to wait.
You're talking like a trader. I don't do trade. Well, I used to, and I was quite good at it until my stomach lining burnt off.
Now, this is the part where Clem explains the actual mechanics behind that massive metals sell-off. And it's not some conspiracy theory. It's institutional rebalancing. When he talks about funds having too much of an asset that's gone up too much, and maybe you shouldn't even have it because it's not in their mandate, he's describing something called portfolio drift. Here's how it works in practice. Let's say a fund has a mandate that says they can only hold 2% in commodities. Gold and silver rip higher by 30 to 40% in a month. Suddenly, that 2% allocation becomes 3 or 4% of the portfolio. Compliance comes in at month end and says you need to rebalance now. And when dozens of funds are doing this simultaneously at the end of January, that's when Clem says, when they all try to leave, they cause a cascading avalanche. That's exactly what we saw. The gold and silver complex all dumped together in the final 2 days of January and then bounced the first 2 days of February. That's not manipulation. That's systematic selling pressure meeting month-end rebalancing requirements. Now, David Lin brings up a valid point about waiting for a 50% pullback in gold before buying, and historically that's happened in 1981 and 2012. But here's where I think the 2025 setup is different. We didn't have central banks buying 1,000 plus tons per year in those previous cycles. We didn't have BRICS nations actively trying to de-dollarize reserves. The structural bid under gold is stronger now than it was in 2011. So while a pullback is possible, waiting for 50% down from 3,500 means you're waiting for gold at 1,750, and I'm not convinced we see that level again given the monetary backdrop. The key takeaway here? Understand the difference between technical rebalancing sell-offs and fundamental breakdowns. Silver had a fundamental problem. It ran too far too fast on retail FOMO. Gold had a technical problem. Funds had to sell for compliance. One is a repricing. The other is a reset. Know the difference. So, what do you guys think of this? Leave your thoughts down in the comments. Please like and subscribe, and I will see you in the next video.